Okay, welcome. For those of you that are watching this via recording, I forgot to turn on record, so let me just take you through things very quickly because I can catch you up in just a moment. And we're talking about decentralized operations. So if we have decentralized operations, such as if we have, whoops, let me actually show you myself here. There we go. Can everybody see myself there? Okay. If we have General Motors, for example, and their headquarters up at the top, we have separate divisions such as Chevrolet, Buick, Cadillac. If we have decentralized operations, these separate divisions control their own operations. If we have centralized operations, on the other hand, the centralized company headquarters controls the operations of each of these divisions. General Motors is very centralized. So here I've got advantages of decentralization and some disadvantages of decentralization. And then I was just talking here in D about responsibility centers. And we just covered a cost center. We just covered a revenue center. You can see these on page 1328. But a cost center, most units in a company are cost centers. They are responsible for generating costs. Accounting is one, manufacturing is one. A revenue center, best example is a company's sales staff. And they're accountable primarily for revenues. They've got to generate revenue, and they want actual revenue to be greater than budget revenue. Then, just right for a profit center. And a profit center is accountable for both revenues and expenses, and therefore for profit. A profit center is like a little business within a business. So with a profit center, if we had, for example, a restaurant in a company, let's say a restaurant where employees can get breakfast and lunch, that could easily be a profit center because they are responsible for generating some profit. So again, like a little business within a business. And if I go back to the book to page 1328, I look here at a profit center. Well, a profit center, again, produces profits through generating revenues and controlling its costs. So we can compare on a responsibility report actual revenues and costs to budgeted revenues and costs. The difference between revenue and cost would be profit. We always, of course, want actual profit to be greater than budgeted profit. Then finally, an investment center. Let me go back to the handout. Number 4 here. So accountable for both profit and the amount of assets invested in the unit. So an investment center is a relatively decentralized unit in general because it does have control over the amount of assets invested in it. Return on investment, or ROI, is a very useful accounting measurement. And an investment center is, again, almost like a business within a business, although it's a bigger segment than a profit center. And very importantly, a profit center does not control the amount of assets invested in it. It doesn't have that degree of autonomy, but an investment center does. So an investment center is usually, again, a bigger chunk out of the company. So if we thought about an investment center and we thought about a company which is more decentralized than General Motors, well, we could think about one which has been in trouble in the past couple of years, which is GE, General Electric. General Electric bought many different types of businesses and had no idea as to what they were buying in some cases. They didn't understand how each of these businesses made money because they were very disparate as far as different types of businesses. So GE had no alternative other than to decentralize and treat each one like an investment center. And GE soon found that this return on investment was not positive at all. In fact, very often negative, because a lot of these separate divisions were incurring net losses. So G has gone through a big operation of getting rid of some divisions, which weren't doing very well. So wasn't very good on its part. Any questions so far? All righty. Well, next topic here is performance measurement. So we see we've got to do this to determine how well units and employees are achieving their goals. We also do this to motivate and reward them, as well as to take corrective action as necessary. And performance measures should definitely promote goal congruence. So again, trying to get employees' goals aligned with those of headquarters. So taking corrective action, for example, if actual costs are greater than budgeted costs, we'd like to know why. Hopefully correct that. Well, one method of integrating goals and performance measures is called the balanced scorecard. So that's going to try to match up what a company's doing on a day-to-day basis with its strategic goals. And I will show you. And we'll see that the balanced scorecard views the organization from 4 different perspectives. And each perspective evaluates a different aspect of performance. And we can look on page 1333. We'll see some information about the balanced scorecard. Excuse me. And we'll see it has 4 different perspectives. So what am I talking about here? Let's flip over there to 1333 and take a look at this. The balanced scorecard came into being early part of the 80s. So it was put together by a professor from Harvard. His name is Robert Kaplan. And I looked him up today, by the way. He's now 80 years old. So he is a professor emeritus at Harvard, a retired professor. I'm sure he doesn't have any financial worries because he's written some books about the balanced scorecard. It's been implemented in business, and he has become and still is a very, very popular speaker. So we won't worry about him. So Robert Kaplan, by the way, was not a professor of accounting. He was a professor of leadership development, so rather akin to management. He developed this balanced scorecard as a way of showing that a company does not add value just through one type of activity it does. So taking all things in balance and seeing everything which ties into a strategy. So it's a good way of organizing things, you'll see. So again, 4 different perspectives: the financial perspective, the customer perspective, the internal business perspective, and learning and growth perspective. So let me come back to the handout here and look at the first one, financial perspective. So how does the organization look to stakeholders, especially stockholders, creditors too? But this includes such items as increasing sales. We'd like for them to increase sales revenue, cutting costs. We'd like for them to be lowered, and increasing efficiency if we can. So let's see that back here in the book. Financial perspective. So that strategy that ties into that. The company's strategy, again, would be to, well, increase company profits. That makes sense. They're increasing revenue growth and productivity. That means increasing efficiency. And then we see some common key performance indicators, or KPIs. Has anyone ever heard the term KPI? Okay. You have, Amber. Yeah, that refers to some very specific numbers that we can take a look at. So we can look at net income. We obviously want it to grow too. Sales revenue growth, we want it to go up. Gross margin growth, we want it to go up too. Cash flow, we want that to go up. Return on investment, we'll see the formula for that in a little bit, but we want that to be as high as possible. So any return we want to be high. Also, we will see the term residual income after a while, and we want that to be high too. So both return on investment and residual income, we'll see the higher is better. Well, traditionally, these are numbers that accountants have crunched. But Kaplan tried to add that we need to not look just at those numbers, not just at the financial picture, but also look at these other three perspectives too, to get a full-blown picture of the company, understand how it translates its actions into strategy for the long term too. So we'll look here at the customer perspective. Again, let me go back to my handout. So number 2 there, the customer perspective. Well, how do customers see the organization? And this includes such items as percentage of market share. We'd like that percentage to be as high as possible. Number of customers, we want that high. Number of repeat customers, that's a very telling one. How many come back to us? Again, we want that to be as high as possible too. On-time rate, because if we're on time, that adds quality in the customer's eyes, plus they're more satisfied. If we're not on time, that's a bad thing. So let me look at this a little bit more closely here in the book with some KPIs. So the customer perspective, again, improve customer satisfaction for long-term success. Unfortunately, GM did not do a good job of that in past years, and they still suffer. So things like customer satisfaction ratings. We want customer satisfaction to be as high as possible. In fact, percentage of market share, we want that to be as high as possible too. Unfortunately, General Motors lost much market share in the 70s and 80s, and they have never regained it. That market share went to foreign automobile manufacturers, especially to Toyota. Then the increase in the number of customers. Well, an increase is good, but again, the number of repeat customers, we definitely want that to be as high as possible. It's a lot cheaper to retain an existing customer than to get a new one. The number of customer complaints, we want that to be as low as possible. Rate of on-time deliveries. Again, if our on-time rate is high, that's a good thing. If it's not, that's a very bad thing. Customers will be dissatisfied. And percentage of sales returns, we want that to be as low as possible. Whenever I think about that, I think about the returns line at Walmart. And it's often long. Of course, stores have traditionally had the largest amount of sales returns after which holiday? Christmas. Yeah, that's one reason that stores are glad to have gift cards, quite frankly. Let someone pick out what they want, use the gift card you gave them to get. Otherwise, if you get them a present, which is an actual piece of inventory, they may not like it and they simply return it to the store. So a lot of those gifts under the Christmas tree, at least traditionally, back they went on the day after Christmas. The internal business perspective. Let me turn here to the handout. Number 3 here. Excuse me. The internal business perspective. Well, what are the business processes of which we must excel in order to satisfy customer and financial goals? And this encompasses the factors of innovation. So design new products and services for the future. Love to design as many as possible. Operations, business processes are efficient as possible. And post-sales service, keeping customers happy after a sale is made. All this in an effort to satisfy customers. Let's have a look at that here. There we go. Internal business perspective. So what we're doing internally, we want to make sure that we improve internal efficiency and effectiveness. So be as efficient as possible, doing things lean and effective, accomplishing our goals. Through this, we want to achieve profitability and customer satisfaction through innovation. We'd like to be as innovative as possible. new products, new services through our operations. So they're efficient, like the assembly line is efficient, and through good post-sale service. A lot of companies lag behind in that latter one. So some KPIs, such as number of new products developed, we'd like that to be high. New product development time, we'd like that to be as low as possible. So from R&D to beginning the product on the assembly line, we want that to be as fast as possible. The manufacturing cycle time, the length of time it takes to get a unit from beginning to end on the assembly line, also known as throughput time. Lower is better there, and that helps with the just-in-time inventory as well. Defect rate, we want it to be as low as possible. Number of units produced per hour, as high as possible. Number of warranty claims received, obviously we want this to be as low as possible. Average repair time, we want that to be as low as possible. Average wait time for a customer service representative, we'd like for that to be as low as possible, but unfortunately it's not. So we know that all too well from these pandemic days, and also trying to get a response from customer service by email. Sometimes these days that is very, very slow, and that's not good. Then finally, the learning and growth perspective. So let's come back here to the handout and take a look at it. So number 4 there, the learning and growth perspective. So how can the organization continue to improve and increase value? And this focuses on employee capabilities, information system capabilities, and the company's climate for action. Are they able to spring into action and adjust as need be? Definitely Zoom was very high on that. So learning and growth perspective. So some strategies here. Let's retain skilled employees. Let's update technology and create a positive corporate culture to provide a foundation for improved internal operations. Let's also sustain customer satisfaction and generate financial success. So some KPIs here. Hours of employee training. Well, often companies cut this short, and we've seen this, for example, in customer service in stores, definitely in restaurants, and we wind up getting very poor customer service. Not good. So the company's shortcutting training, very bad. Number of cross-trained employees. It's good to have that as high as possible. So in a restaurant, someone can cook food, they can tend to the salad bar, they can wait on tables, they can bartend, etc. That's a cross-trained employee. Then percentage of computer downtime, or downtime of anything, including machines on the assembly line. We want that to be as low as possible. Then percentages of processes with real-time feedback on quality, cycle time, length of time on the assembly line, and cost data. We'd love to have real-time feedback on as much as possible. Real-time means we get it right away. This way, if a problem is developing, we know about it now and will take corrective action. Well, then employee satisfaction. Want that to be as high as possible, but often it seems like a lot of companies don't pay as much attention to it as they should. Employee turnover. We'd like for that to be as low as possible. You know, a lot of companies don't pay too much attention to that. A lot of companies don't pay attention to the number of employee suggestions implemented. Sometimes they don't listen to employees, and that's too bad because they're not listening to their frontline people. So that's the flavor of the balanced scorecard there. Any questions so far about the balanced scorecard? Okay. Well, they're here in Roman numeral 3. So measuring the financial performance of cost centers, revenue centers, and profit centers. So some of this we've seen before, but just touch on it a little bit more thoroughly. First of all, cost centers are responsible for activities which generate costs, as we know. And a favorable cost variance is when actual cost is less than the flexible budget amount, or any budget amount. Don't worry about flexible. We didn't cover those in this class. But an unfavorable cost variance is when the actual cost is greater than the flexible budget amount. So again, we want cost to be as low as possible. If it comes under budget, if actual cost is less than the budget amount that's a good thing. That's a favorable variance. I'm not worried about that exhibit. Then again, revenue centers we know are responsible for activities which generate revenue, and we want revenue to be as high as possible. So a good thing or a favorable revenue variance is when the actual revenue is greater than the budget amount. Again, don't worry about flexible. But a bad thing or an unfavorable revenue variance is when actual revenue is less than the flexible budget amount. We don't like actual revenue to be less than budget. That's bad. And then C, profit centers. They're responsible for generating a profit. And they have both revenue and cost variances as well as profit variances. And with a profit variance, we want profit to be as high as possible. So actual profit greater than budget profit. So a good thing, a favorable profit variance is when the actual profit is greater than the budget amount. A bad thing or an unfavorable profit variance is when the actual profit is less than the budget amount. Not good. Then we can also measure the financial performance of investment centers. And since they do have control over the amount of assets invested in them, we have a larger job to do here. It's not difficult, but just a few things I want to bring up. So A, again, as we know, an investment center is usually a large division and cannot be evaluated solely on income because income does not measure how efficiently that division is using its assets. Instead, it can be evaluated on 3 other measures, and these are discussed next. Each one of them does include some measurement of assets, since that investment center does have control over the amount of assets. So first of all, return on investment. Well, the formula can differ slightly, but most of the time what's used is operating income divided by total assets. Again, we want that to be as high as possible. We love for this income to be greater, have a greater return rate. Now, in B, or rather in 1 under B, sometimes this is expressed in its extended form, and you'll get more into this in managerial finance. But return on investment equals profit margin times capital turnover. What are those? So profit margin is operating income divided by sales revenue. We want that to be as high as possible. Capital turnover is sales revenue divided by total assets. Again, we want that to be as high as possible too. So that's why I say in number 2, higher is better for all these measures. Then residual income, I mentioned that a little bit ago, RI. It just means operating income minus minimum acceptable income. So what does minimum acceptable income mean? Well, it equals management's target return or target rate of return, which will be given to you. So how much of a percentage they wish to earn, multiplied by total assets. So that's the bare minimum amount of income management wants. So if we subtract that from the actual operating income of the company, we want this difference to be as high as possible. So residual income to be as high as possible. So that's why I say higher is better. In fact, that makes sense because for any income figure, we want more. Okay. Then economic value added, EVA. It's a special type residual income calculation. Now it looks at a division's residual income through the eyes of the 2 primary stakeholders, which are investors and creditors. And it considers the income available to these stakeholders, the assets used to generate that income, and the minimum rate of return required by the stockholders, by the stakeholders, rather. Stakeholders, well, include stockholders plus many more people. And the latter is called the weighted average cost of capital. I will show you. It's going to replace management's target rate of return, which is used in the residual income calculation. So EVA equals this. After After-tax operating income minus everything here. Total assets minus current liabilities, so a difference there, the remaining assets left, in other words, times a percentage that will be given to you for the weighted average cost of capital, which is the return which stakeholders want. And again, higher is better. We'd love for this difference to be as great as possible. So our actual income is greater than what the stakeholders want. Again, more about that managerial finance. With these, you'll have the formulas as you take the test to calculate these. It's just a matter of plugging in numbers. Will not be bad. Then, any limitations of financial performance measures include the following. So first of all, measurement issues, such as how to value total assets. Do we use all historical costs? Do we use some fair market values? If we use fair market values, how do we determine them? For example, International Financial Reporting Standards has 3 different methods to calculate fair values. So there's a lot of subjectivity there. Then short-term focus, because financial performance measures show what has just happened in the past. So that ties into number 3, focusing on historical results. We're trying to use immediate history, so the immediate accounting numbers, to forecast the future. We can only do so for a very, very short term. And wow, that was not a bad chapter at all. Didn't take much time. Things do go faster here online. Any questions? If you do have questions, please let me know. We only have a couple of chapters left. We're almost there. All righty. Well, please let me know if any questions develop, and otherwise, I'll see you Wednesday.